Hello, knowledge seekers. In this episode of 20-Minute Books, we delve into Warren Buffett's Ground Rules, a fascinating study of the investment philosophies of one of the wealthiest and most successful investors in history. Authored by Jeremy C. Miller, a seasoned New York-based investment analyst, this book distills the essence of Buffett's early career, focusing on the letters he wrote to his partners between 1956 and 1970. Through these communications, Miller extracts invaluable advice and strategies that remain relevant for anyone looking to navigate the complexities of the stock market today. The author, Jeremy C. Miller, brings over 15 years of experience in the financial industry to bear on this analysis, making his debut work not just insightful, but also rooted in practical experience. Before turning to writing, Miller honed his skills in equity sales and research, and currently serves at a leading mutual fund company. Warren Buffett's Ground Rules is designed for a diverse readership. Whether you're someone who can effortlessly quote Gordon Gekko, a gambler interested in the disciplined arena of stock market investment, or someone who longs for the booming economic eras of the 1980s and 1990s, this book has something for you. It offers a window into the early thinking and strategic planning of Warren Buffett, providing guidance that could help shape your financial future. Join us as we unpack the timeless investment wisdom that has propelled Buffett to the pinnacle of financial success. Warren Buffett's Ground Rules, Words of Wisdom from the Partnership Letters of the World's Greatest Investor. Introduction. Unlock the secrets to wealth with Warren Buffett's investment strategies. Imagine a world where your financial worries are replaced by an overflowing abundance of wealth. Sounds like a dream, doesn't it? Yet this dream is not as far-fetched as it might seem, especially when you have a mentor like Warren Buffett, the fourth wealthiest individual on the globe. His journey of becoming a stock market maestro makes accruing riches seem almost effortless, boiling down to a deceivingly simple strategy: purchase when prices are low and sell when they're high. Despite this seemingly straightforward approach, mastering the stock market is anything but simple. Fortunately for us, Warren Buffett hasn't kept his strategies a closely guarded secret. With the inception of his company, Buffett Partnership Limited, in 1956, Buffett embarked on a mission to demystify the complexities of the stock market through letters to his partners. These letters were filled with insights into his market perceptions, future forecasts, and his overarching investment philosophy. These writings weren't your typical dry financial dissertations. They were peppered with wit, making them not only educational but also enjoyable to read. Over 14 years, Buffett amassed a treasure trove of these letters, which collectively hold the key to initiating and, more impressively, sustaining a successful career in stock investments. But what exactly can we learn from Buffett's wisdom? For starters, investing in something as reputed and valuable as the Mona Lisa might not translate to a sound financial move for an entire nation. Furthermore, discover how Buffett unintentionally executed his first arbitrage transaction, all while being blissfully unaware of it at the time. Most crucially, understand why having patience is an indispensable trait that serves every investor, regardless of their market strategy. So, if you've ever harbored dreams of financial prosperity with minimal effort, Warren Buffett's insights might just be the roadmap you need. Remember, success in the stock market might require a stroke of luck, but more than anything, it demands consistency and patience. Join us as we unpack the wisdom behind Buffett's principles, one insightful piece at a time. Part 1. Unlocking the Secret to Wealth. The Power of Patience in Investing. In the bustling world of Wall Street, there lies a secret so profound it has propelled Warren Buffett into becoming one of the wealthiest individuals on the planet, boasting an astounding fortune of $88.9 billion. Ready to discover this secret? It's surprisingly straightforward. Patience. Yes, The key to building wealth lies in careful, measured investment rather than the whirlwind of speculative trading. The distinction between investment and speculation is crucial, yet often misunderstood. Speculators ride the tumultuous waves of market trends, buying and selling stocks in a high stakes gamble to strike it rich overnight. Investors, in contrast, take a more deliberate path. They invest in businesses based on thorough analysis of their real value, and then they wait. Warren Buffett, the Oracle of Omaha, epitomizes this investor ethos. With his roots in the Midwest and an education from a New York business school, Buffett's investment approach, heavily influenced by his mentor Ben Graham, blends rigorous analysis with a straightforward, patient strategy. At the heart of Buffett's philosophy is the understanding that over time, the market price of financial assets like stocks will align with their intrinsic value. Investing in a stock means buying a piece of a business. Its price fluctuates based on the company's performance. If the business thrives, its value and consequently its stock price go up. Conversely, any loss in value, perhaps due to a scandal, triggers a drop in the share price. Therein lies the opportunity. Stocks occasionally don't reflect the true value of the business they represent. Savvy investors who pick such undervalued stocks and await the market's adjustment stand to gain significantly. The essence of this approach is a focus on the what of the market's behavior rather than the when. Trusting that the market price will ultimately mirror a business's actual value paves the way for eventual profit, encouraging investors not to panic sell when the market takes a dip. At the core of this patient investment strategy is the magic of compound interest, the phenomenon where earnings on an investment generate their own earnings. Renowned physicist Albert Einstein hailed compound interest as the world's eighth wonder, a tool for those who grasp it to amass wealth and a burden for those who overlook its power. A compelling illustration of compound interest potential that Buffett admired concerns the Mona Lisa, purchased by King Francis I for the equivalent of $20,000 in 1540. Had that sum been invested at a 6% compound interest rate, by 1964, France would have amassed $1 quadrillion. This revelation about the essence of investing redefines the journey to wealth. It's not about quick gains, but about developing a patient, informed investment strategy, capable of harnessing the incredible power of compound interest. As we delve further, we'll explore how to carve out a personal investment style tailored to harnessing this timeless principle. Part 2. The cornerstone of investment success, the art of measurement. Warren Buffett is a towering figure in the investment world, not just for his vast wealth, but for his uncanny ability to consistently outpace the market. Even in his early days, with much to learn, Buffett wasn't daunted. He set his sights on a formidable adversary, the Dow Jones Industrial Average. His goal seemed simple yet ambitious: to ensure his investments grew at a rate faster than the market itself. Achieving this, however, was anything but straightforward. Here's a universal truth about successful investors: they are measurement maniacs. Imagine the trepidation of checking your bank account after a spree of expenditures or gauging your weight loss progress. The fear of disappointment can be paralyzing for many. Yet, in the world of investment, akin to Warren Buffett's realm, overcoming such fears is non-negotiable. Rigorous measurement, insightful analysis, and maintaining composure amidst market fluctuations encapsulate the essence of investment success. Let's talk bluntly, as Buffett does. The stark reality is that surpassing market performance is a feat that eludes most investors. Buffett's ambition to consistently achieve returns greater than 7% per annum was nothing short of audacious. Nonetheless, the marvel of compound interest demonstrates that even marginally outperforming the market can set the stage for considerable financial prosperity over time. But what truly separates the wheat from the chaff in investment? The answer lies in relentless measurement. This entails daily monitoring of your investments, comparing present outcomes against historical performance, and practicing patience during downturns. It demands energy, dedication, and importantly, the capacity to discern when persistence or withdrawal is the prudent course of action. Yet this rigorous measurement isn't solely introspective. It also involves gauging your progress relative to the market each year. Thus, even when the market declines, if your investments falter slightly less, it's a victory in its own right. On a brighter note, surpassing the market's performance today may not be as Herculean a task as it was in Buffett's youth, thanks to the advent of index funds. Launched in 1975, these funds aggregate varied company stocks within a given stock exchange, closely mirroring the fluctuating fortunes of the market itself. Buffett's counsel for those lacking the time or inclination to deeply engage with their investments is simple: buy into the index. It's a strategy that aligns with the passive investor's capacities while offering a slice of the market's overall performance. For the actively involved investor, though, the path to success is clear. Relentless measurement is your compass guiding the way. Part 3. The strategic advantage of young investors. Targeting undervalued companies. Embarking on your investment journey is much like shaping your own masterpiece. It's an art that requires precision, insight, and above all, a reflection of your unique essence. Your investment approach should mirror not just your financial ambitions, but also who you are, your interests, available resources, and specific skill sets. As an abstract example, an individual deeply rooted in the care of alpacas may find little resonance with the intricate world of semiconductor investments. Here is a silver lining for the nascent investor or those with modest beginnings. The realm of investment harbors a peculiar advantage for you. Contrary to the belief that greater capital confers an upper hand, managing smaller sums may actually unlock opportunities in overlooked nooks of the market, such as small companies not listed on major stock exchanges. These can potentially yield substantial percentage gains, an opportunity that diminishes as one's capital swells to necessitate larger deals for significant impacts. When Warren Buffett embarked on his investment voyage in 1956 with a little over $100,000, by 1960 his portfolio had impressively surged to $1,900,000. This remarkable growth was chiefly credited to his strategic investments in smaller, modest ventures, a testament to the efficacy of focusing on the underrepresented sectors of the market. Central to this strategy is a particular kind of investment that Buffett aptly named generals, companies that are fundamentally undervalued. Buffett, endowed with a remarkable aptitude for assessing a company's value, found his niche in investing in generals. He describes these as moderate businesses available at strikingly low prices, essentially good deals not accurately reflected by the market. These investments often languished in his portfolio for years, yet this patience invariably bore fruit, underscoring the merit in the wait. Buffett's investment philosophy also entertained a fascination with companies that presented more value in their liquidation than in their operational state, a classification he humorously dubbed as net. This approach provided a safety net, pun intended, ensuring that even in declining business health, liquidation wouldn't precipitate a loss. Labeling these investments as his cigar butts, Buffett acknowledged their lack of allure. Nonetheless, upon reflection, 12 years into his career, he recognized these as the investments that yielded the highest average returns. As Buffett's journey progressed, so did his perception of value, transitioning from the allure of low prices to the intrinsic quality of the business and the sustainability of its earnings. His philosophy matured from procuring decent businesses at great prices to acquiring splendid businesses at reasonable prices. As you gain traction in your investment adventures, you might feel an urge to delve into managing one of your ventures. Venture forth, guided by Buffett's insights, but brace yourself for an additional set of guidelines lying on the path ahead. Part 4. Embracing risk in familiar territories. A path to greater rewards. Imagine a young Warren Buffett, a mere child, dabbling in his very first business transaction with a simple yet ingenious plan. He purchased a six-pack of Coca-Cola for 25 cents from his grandfather's store and resold the bottles individually to his friends for a nickel each. This venture wasn't without its perils. A day without thirsty kids meant a potential surplus of unsold sodas. However, on a successful day, Buffett would see a 20% profit on each six-pack sold. This childhood endeavor encapsulates a profound lesson. Assuming more risk in markets you know well can yield even more reward potential. Buffett, in his youthful naivety, was engaging in what's known in investment circles as arbitrage, capitalizing on the price discrepancy of a single product across different markets. In this case, the product was Coca-Cola, and the markets were his grandfather's store versus his neighborhood companions. Arbitrage, specifically when it concerns buying parts of companies, can be particularly lucrative. It involves strategic buying of stock in a company with the anticipation that its value will increase due to events like mergers. Such merger arbs were among Buffett's early triumphs as an investor. Through these, he wagered on the increased worth of companies post-merger for attractive returns. Yet, the rewards come tethered to risks, making arbitrage a complex playfield for the average investor. Its success requires a deep knowledge of the involved businesses and markets. Without this expertise, especially in your field of specialization, arbitrage is a challenging endeavor. For those seasoned investors not keen on navigating the precarious terrain of merger arbitrage, another avenue Buffett explored was investing in controls. This strategy involves acquiring a significant stake in a publicly listed company, enough to wield influence over its management decisions. Venturing into controls can lead to tense dynamics between the company's existing management and the new, change-demanding board members. In his early years, Buffett faced criticism for such interventions, believing he was streamlining operations by eradicating inefficiencies. However, as Buffett grew in his career, he steered away from the convoluted mess controls could become, preferring not to involve himself in the potential fallout of layoffs or firings. Despite this evolution in strategy, Buffett's underlying investment philosophy remained steadfast, championing a calm and calculated approach to building wealth. In our continuing exploration of Buffett's investment saga, we'll unveil why this steady, unflustered demeanor has been pivotal to his remarkable success in the investment domain. Part 5. Steadfast Principles in the Ever-Shifting Sands of the Market. It's a primal instinct to follow the herd, especially when danger looms unseen. Yet, in the intricate world of investing, this instinct can lead one astray. The stark reality is that being part of the majority inherently means settling for average results at best. For investors seeking success, the challenge lies in learning to chart a course that diverges from the crowd. Warren Buffett, a paragon of investment ingenuity, has demonstrated time and again that there's only one scenario where investing should be considered: when the investor has a complete grasp of the situation and the ensuing best course of action. In any other scenario, the wisest move is to abstain, regardless of the prevailing market euphoria. This introduces a vital premise. While your strategies may evolve alongside market dynamics, your underlying principles should remain constant. Buffett's investment journey began amid market conditions deemed overwhelmingly expensive. Yet, as stocks persisted in their ascent, Buffett held firm to his conservative stance, fortified by the belief that a market correction was inevitable, though its timing remained uncertain. Amidst this, contemporaries like Jerry Tsai in New York were making monumental gains through a novel investment strategy that capitalized on the burgeoning speculative interest among the public. Tsai's method was antithetical to Buffett's. He would swiftly enter and exit stock positions, riding the waves of market volatility. This strategy bore fruit temporarily for Tsai, delivering spectacular returns despite the ensuing volatility. In contrast, Buffett remained unwavering in his belief that such gains were unsustainable. 1966 marked a peak for the stock market, prompting Buffett to cautiously halt the acceptance of new partners and to recalibrate his performance targets. Despite these adjustments, 1968 emerged as an exceptionally profitable year for his fund, boasting a remarkable 58.8% return. However, recognizing the impending market downturn, Buffett opted to withdraw, securing his wealth against the looming market collapse. Tsai, too, sensed the impending downturn, offloading his fund at the opportune moment in 1968. The subsequent market crash in the early 1970s, the most severe since the Great Depression, left Buffett's fortune intact by virtue of his preemptive retreat. Tsai, though narrowly escaping a personal loss, witnessed his investors face a devastating 90% decline in their portfolio assets. Buffett's unwavering adherence to his investment convictions serves as a beacon for all investors. The essence lies in identifying and firmly believing in your principles. When the moment aligns with these convictions, it's time to make significant moves. With a foundation built on solid principles, success is almost inevitable. Final summary. Venturing into the stock market might seem like a daunting journey, fraught with uncertainties and complex decisions. Yet, the dream of financial prosperity through stock market investment is not only achievable, it is within the reach of those who approach it with diligence, strategic foresight, and a learner's mindset. Drawing from the wealth of knowledge and experience of one of the greatest investors of our time, Warren Buffett, we find invaluable guidance that can illuminate our path. Central to Buffett's philosophy is the importance of careful measurement, a meticulous approach to tracking and analyzing your investments to ensure they align with your financial goals and market realities. Yet measurement alone isn't sufficient. The true essence of successful investing, as emphasized by Buffett, lies in the virtue of patience and the discipline of consistency. It's about playing the long game, understanding that substantial wealth is accumulated not through hasty, speculative bets, but through deliberate, well-informed decisions that pay off over time. Buffett's journey underscores a simple yet profound truth. Anyone is capable of achieving success in the stock market. It's not a realm reserved for the financial elite or those with insider knowledge, but rather a landscape that rewards persistence, informed risk-taking, and an unwavering adherence to one's core principles, even as market dynamics shift and evolve. By embracing Buffett's insights on patient investment, the meticulous evaluation of potential stocks, generals, and the courage to diverge from the herd mentality when necessary, aspiring investors are equipped with a roadmap to navigate the complexities of the stock market. Success, according to Buffett's teachings, is not a product of random luck or speculative ventures, but the outcome of a measured, principled approach that prioritizes long-term gains over short-term wins. The journey to becoming a successful investor is a marathon, not a sprint. It requires commitment, a willingness to learn from missteps, and above all, a steadfast dedication to the principles that underpin wise investment decisions. With these tenets as our guide, the aspiration of building wealth through the stock market transitions from a distant dream to an achievable reality. Thank you for joining me today on this journey of learning and discovery as we explored the insights of another thought-provoking book in our growing library of knowledge. If you've enjoyed our time together, please take a moment to follow our podcast, give us a 5-star rating, and share 20-minute books with other knowledge seekers. Your support truly means a lot. Don't forget to join me again in the next episode, where we will delve into another enriching book. Until then, happy reading and happy listening.